Competition. We've all competed at some point in our lives. It happens all around us. In nature, it's the competition for resources. In sports, it's the competition to be number one. In the stock markets, it's the competition for capital. Our success in competition depends on numerous factors, which can give a persistent advantage to some competitors. We see winners as having strong relative strength, which means they win more often than they lose. If we were to rank all competitors in each arena against each other, you would notice the winners would consistently rank at the top. So how do you rank competitors against each other to reliably determine who might be the winner? The ATP rankings in professional tennis provides a good understanding of how a strong ranking process is developed. Throughout the year, thousands of tennis matches are played at tournaments all over the world. The results of these one-on-one matches are recorded and used to calculate the overall standings of every player. Those players who won more head-to-head battles and progressed further in tournament play would earn more points and therefore would rank higher in the standings. The rank of every player on any given day would be a good indication of their relative strength versus their entire peer group at that time. As a result, the expectation of the top-ranked players to continue performing well versus their peer group would be highly favorable. Over time, the movement of the rankings would reflect a change in trend within the player universe. This ranking process can also be viewed in the financial markets as well. At SIA Wealth, we compare the price movement of every investment against its peer group every day to determine its relative strength. Similar to tennis rankings, each investment is then ranked versus its peer group. The power of the relative strength approach is in its ability to use this ranking process at multiple levels in the investment universe. It can be used to rank geographic markets globally, or asset classes, or sectors, or individual investments like stocks, ETFs, and mutual funds. At every level, the investor could determine who is winning more of the head-to-head battles to provide a gauge as to where the strength may continue and when there is a possible change in trend starting to occur. Ultimately, investing deals with probabilities, not certainties. Relative strength investing seeks to identify investments with higher probabilities of continued strength to empower investors to compete in the markets. Compete with relative strength. Partner with SIA Wealth. For more information, visit us at siawealth.com and talk to your investment advisor. Good day, everyone, and thank you for joining us. This is Jason Leeswee, and I'm joined by our Chief Market Strategist, Colin Sazinski. This is our latest video from SIA Wealth. It's the fourth video we've created this year explaining our relative strength and true tactical process. We hope you're finding them useful with your clients. In each video, we end it with talk with your investment advisor. And so we remain focused on providing the advisor community with materials to enable you to hopefully have meaningful conversations with your clients and prospects. Before I hand it over to Colin, if there are any questions, please feel free to type them into the question box and we'll respond to each one individually after the webinar. In addition, we've added a short survey at the end of this webinar and would greatly appreciate your feedback as it will help us determine how to best serve you in 2022. And now I'll pass it over to Colin to address the most asked questions we've received from advisors over the past month. Colin?
Thank you very much, Jason. There's been a lot of change in the markets over the last month or so, a seasonal change as well as some significant trend changes, which we're going to outline as we move through today's presentation. So our primary agenda for today is to, as Jason mentioned, is to answer some of the questions we received from advisors over the last few weeks, and that's where we'll begin. So our first question was related to equity seasonality. And this is something we've talked about in some of our recent presentations. So the question was, I previously mentioned that the seasonally weakest time of the year usually ends in October. Where are we at now? So I'm going to bring up the a slide that I've used for many, many years. I dated back to 1987 is when I started this collecting this data from. And what it shows essentially is we look at the blue line is our seasonal average of each month from 1987 to 2020. So we can see January and February, March, April, the year usually starts off pretty strong, and then equity momentum slows in May, June, July, August, September. And there's a reason why people say sell in May and go away, and it has to do with the seasonal aspect of this. In fact, June is often one of the weakest months. August and September historically are the three weakest months. You often actually, for traders, get a rebound in July around the earnings season, but then that tails off. October is a positive month, but October is also a mixed month because many times we've seen October start off slow and then turn around dramatically as the month progressed. And we certainly saw that this year, where we had a very weak September and a weak start to October, and then the markets came back dramatically into the end of October. November and December historically have also been stronger months of the year for equity markets. And this ties in with the notion of the Santa Claus rally as an example, as people start to look ahead to the upcoming year. Another thing that we've talked about in one of our themes in our presentations over the last 6 months has been the sideways trend in markets, and combining with the sideways trend, the notion of rolling takedowns and rebounds, and that's been persisting for some time. It's been hard for anything to really get going. Markets have been basically trendless, and it's been quite confusing for the last several months. In the last few weeks, so several U.S. indices have now reached new highs. And so we do have people asking, well, is this sideways trend still the case, or are we starting to move back into a primary uptrend for equities? And so first of all, when we're looking at the uptrend, I always go back 100 years ago to Charles Dow and Dow theory, which basically he outlined the notion that for a market to be in a trend, the Dow Industrials and the Dow Transport should be confirming each other, whether that's upward or downward. And the reality is, for the last 6 months, they weren't really confirming each other. We had the industrials kind of creeping upward, but the transports struggling, or the transports were doing well and the industrials were struggling. But in the last few weeks, they've actually both started to do better. So here's the Dow Industrial Average. We can see have soared at the start of the year up into May. After through May, June, and into July, it was kind of going sideways. The later part of the summer, it creeped up, had a bit of a correction into early October, and now it's rallied up to a new all-time high. Things are looking great for the industrials. The Dow Jones Transportation Average had a big rally up into about May. It then had a steep correction, and when the industrials were starting to creep up to new heights in the late summer, the transports were not confirming. Well, that's changed dramatically in the last couple of weeks. We've seen the transports starting in October absolutely soar up off of and up to a new all-time high. And because of that, we've seen now the transports are confirming the industrials, and both are in new upward trends. Another one here we're looking at, index I'm looking at in particular, is the Russell 2000. This has been the textbook paper example of the sideways trend we've seen in markets for the last 6 months. The small cap, broad-based Russell 2000 absolutely soared through the first couple of months of the year. Then from March through to November, it ended up stuck in a sideways range between about 2100 and about 2350. And this is the example here of the sideways market that just was not going anywhere. Nothing could get going. Subsequently, and more recently, the Russell 2000 has broken out to a new all-time high. And this is significant. This signals that gives another confirmation that an upward trend is unfolding in equity markets, and more importantly, also that there's breadth. That because when we look at the markets and why it was such a challenge was twofold. One, we had this sideways trend where anytime something would get going and start to look great, then it would roll over. And something else would start to go, and then something that looked terrible was looking good, and this back and forth where nothing was really going, and things were offsetting each other. Very confusing and difficult time to invest. And it's not just for momentum strategies or for regular investors. I mean, really any kind of active strategy struggles in that kind of a market, and that's reality. And then the second thing we were running into, and a lot of managers were running into, was that the gains we were getting through the latter part of the summer were really in about 5 or 6 stocks. And it was these 5 or 6 big mega cap stocks that were really pushing the indices to new highs, and then other things looked like they were lagging. And it was a real problem because in that kind of a market, it's tough for any kind of an active manager to do well because you have concentration rules. A lot of managers have concentration rules that the indices don't have. And when you get these absolutely biggest cap concentrated in one or two sectors, pulling the whole index up with them, it makes it difficult for anyone to keep up. And so that was one of the things that was happening. So in this situation we're moving into now, we're in the situation where the broad market equity uptrend does appear to be resuming. And although we have seen some choppiness as we've moved into November, and more importantly, though, it's become more broadly based. It's created more opportunities for investors and for active managers and relative strength and momentum and other strategies to start to move forward again. And that being said, in the last few months at SIA, we do remain tactical and we do respond to market conditions. So through this sideways market of the last several months, we actually had built up a cash and short-term cash and short-term bond position in a number of our portfolios to the tune of 20 to 30%. So in a time where equity signals have been confusing and distorted and other things, we actually had built up a bit more of a defensive stance, taking it on. And even with that the case, we have still, especially in the last 2-3 months, have continued to perform. So the stock selection side has continued to work. We've also had a defensive component to our strategy as well, and yet we continue to keep up with markets, or reasonably close to, and in some cases exceeding. So it's overall, we continue to monitor equity market conditions, and we are prepared to respond as things evolve over time. So moving now to our next question, market insights on inflation and monetary policy. One of the big things we'd seen last month was two things really was what that have influenced markets. One has been inflation numbers, and the other has been changes in monetary policy. So I talked about a number of short and long-term issues we mentioned in the Uncharted Waters webinar of last month, and we talked about the double bubble and a number of other different indicators. But out of these factors and risks, which one's having the most immediate impact? The most immediate impact right now is inflation and monetary policy. That's where investors are really focused in terms of some of these bigger long-term issues. The most immediate one is has been inflation of late, and we've seen this in a number of ways I'll speak to over the next 2 slides. So first of all, inflation. The central banks have been talking for the last year or more about, oh, inflation is transitory. It's all just commodity prices bouncing back off lows, and it'll all go away. Well, it's not going away, and it's not so transitory. And while commodities are going up and down, we're also seeing it spill over into wages, and we're seeing supply chain disruptions spilling over into inflation and other things. So if we look just at a few metrics here, the US Consumer Price Index last week came out at a 6.2% annual rate, up from 5.4% back in the summer. US house price growth getting up close to 20% over year, and the wages, average hourly earnings, continuing to climb, currently 4.9% over year, previously was 4.3%. In Canada, the same sort of thing. We're seeing consumer prices continuing to rise as well, 4.4% in the last month's reading, and 3.7% back in the summer. Now, the next inflation report for Canada is this week, so we will be, a lot of investors will be monitoring that closely. We also have consumer price information for the UK coming out this week as well, that could attract quite a bit of attention from investors. And so moving, not only that, so I'm talking, that was the US and Canada, but what I wanted to show on this slide was this inflation pressures are really going on pretty much everywhere. And important for us to remember, the most central banks have a 2% target for inflation. And some of them, that's their long run target, 2% inflation, 2% interest rate. That's neutral monetary policy, and that's kind of the goal. a lot of central banks had said, okay, well, inflation is now going a little bit above 2%, but we'll let it run a bit so it averages out 2% over the cycle. Well, we're getting pretty far above that. If we look at consumer price numbers, 6.2% for the States, about 4% give or take in Canada and Europe. Producer prices, 8.6% in the US, 11% in the UK, 16% in the EU. I mean, this is inflation is more than running a little bit above average here. And it's becoming a situation where more and more central banks are realizing that they have to start to do something about it. And so what the central banks have been doing increasingly is starting to normalize policy, to take away the stimulus that's there and the easy money that's being pushed into the markets and really helping to spark inflation. I mean, you use this to stave off deflation, but at the same time, if they're not careful, they run the risk of creating inflation as well. So actively tapering at the moment, the hawkish side, we have the Bank of Canada, who has ended their stimulus program and moved up their timetable for the first rate hike to April to September of next year. And even this week, the Bank of Canada Governor Tiff Macklem has been out talking about that they've been moving up their timetable and potentially they may have to do it again. The Reserve Bank of New Zealand also ended their stimulus program and has started to raise interest rates. The Federal Reserve Board in the States, they're starting to taper off their stimulus program as well, to the tune of $15 billion a month, with their plan to end their QE program by the middle of 2022. We'll continue to monitor that to see if that gets accelerated or not, or how quickly thereafter they may be ready to start raising interest rates. We'll see how things go, and some of that may have to do with depend on who's actually even running the Fed next year, since that's still up in the air. There's a couple of central banks that are talking about tapering and leaning hawkish. So the Australian Central Bank had been running a yield curve operation. They've ended that, and now they're letting their yield curve normalize, and they're talking about tapering back asset purchases sometime in the first quarter of next year. The Bank of England had been talking about tapering, and people were actually expecting them to do it at their last meeting, and they didn't. And in fact, it's interesting because it used to be that investors would cheer stimulus. Well, the Bank of England left their stimulus on, and the pound got punished. Literally, it got pounded on the news. So the investor sentiment towards this and concern about inflation is even impacting how they respond to what the central banks do. No current plans to taper stimulus as a dovish camp. The European Central Bank has moved back into the dovish camp. They said no tapering this year. And the Bank of Japan, they may be tapering forever. Nobody really knows. They're not even thinking about tapering. So the question is, as we look at this, is how have the prospects of rising inflation and less dovish central banks impacted market sentiment and capital flows? Well, if we look here at the TSX composite, the Canadian market continues to soar. Canada is its largest areas are financials, as well as materials and energy are the three biggest sectors. And we've seen some gains in materials lately, particularly precious metals. We've seen energy prices going up, and financials reflecting a stronger economy. And in fact, with the financials, the bank earnings are coming up in a couple of weeks. The regulators in Canada have allowed the big financial institutions to start raising dividends and increasing buybacks. So immediately we saw that with the insurance companies, and so don't be surprised when the banks report results later this month if we see news from some of them on dividends and on buybacks. But why is inflation important for the stock market and important for investors? And the reason is inflation erodes. Not only does inflation erode the value of paper money, so that all else being equal, if you have a market that's flat and you have inflation, you're losing money on a real basis. But generally speaking, this slide here, which was also we used in last month's webinar, and because to me it's quite an important one, especially as inflation continues to rise, is that the higher the inflation rate, the poorer even the nominal return of stock markets have been. So if we looked at CPI less than 0 or down in 0 to 2% or even negative, we've had an average market return over the last 100 years of about 8%. Once we start getting above 1% 2%, 3%, 4%, 5%. At above 5%, which is actually where we are now, the historic return starts to go negative, even in nominal terms, for the U.S. stock market. And this chart is based on 100 years of data, 1921 to 2020. And then once you got up above 7%, 8%, 9%, that tends to flatten out at about a return of negative 4% on average. So the issue here is, as we look forward, rising inflation is a concern for central banks that want to that have been trying to keep equity markets rolling. A rise in inflation is a real problem, and we may start to see more tightening moving into next year, perhaps even interest rate increases in a number of countries. Just to note here, I thought I'd show also just what's happening with bonds at this point. We're seeing that really bonds, like stocks, have been in a sideways market for the last 6 months. In the case of bonds, they're just kind of still sitting in the middle. They're not really going anywhere yet. I think a lot of investors are still trying to make sense of what are the central banks doing, what does inflation really mean for the markets. And even interestingly enough, the 10-year interest rate is still kind of sitting sideways as well, between about 1.25, 1.75, and is sitting in and around 1.50, just slightly above the middle of this range. So we did have a move up in the traded rates at the beginning of this year, and since then they've just kind of been consolidating. So we saw investors kind of recognize it's an issue, and now it seems as though, again, they're just the fixed income side is telling us they're just kind of waiting to see what happens. Where something has happened though, and the really big thing we saw this month is last week's breakout by precious metals. And it wasn't just gold, it was silver, it was platinum. All three broke out on the same day. Major bullish pattern completions, and broke out of a downtrend. So this is quite really significant here that gold was starting to move. Gold and precious metals are hard currency. They're considered to be a store of value in inflationary times when the value of paper money is being eroded. And now it was the very day that the U.S. printed their consumer price report. Boom, all the precious metals broke out. This has also had a positive impact as well on precious metal stocks. We have seen in some of our studies that precious metal producers have been starting to show increased relative strength and moving up in the rankings. So there's it seems to be a more broad-based increased interest coming in to precious metals, and most likely this is as an inflation hedging. Sometimes people will use it as a hedge against extreme volatility as well, or uncertainty, but this time around it looks like it's more inflation driven. This is an example as well of platinum. Same thing. We can see platinum last week also broke up out of an uptrend, same day as gold and silver. The last section and the last question we had was related to a broader question about energy and commodity prices. Both crude oils and natural gas have climbed to their highest level in years in recent weeks. And so the question has been, is this the start of a new bull market for commodities in general and energy markets in particular? And it's interesting because we are still seeing, even over the last year, different commodities moving in different directions at different times. The most significant one, though, is renewed interest in energy, no question about it. If we look back here, the crude oil recent breakout over 77.50, it cleared its 2017 high, and crude is now trading back comfortably at its highest levels since 2014, since the start of the bear market of the 2014 15 bear market in oil. We're back to where it was just before the wheels fell off. So this is quite encouraging, and we've seen that oil has continued to trade quite comfortably above these levels. There's been talk of, well, what would the U.S. do? How might they respond? Open the Strategic Petroleum Reserve like Trump did 4 years ago, which formed the last peak, or what? I mean, so far the U.S. has asked OPEC Plus to increase productions, and they faster than they are, and they said no, they're just sticking with the program. And of course there's other uncertainties out there, but overall at this point in time, crude oil has still been trading comfortably above the $80 level. An even more interesting one here looking back over the long term, is natural gas. Gas, back earlier this year when we had the impact of the hurricanes, actually peaked up to its highest level since 2008, which is quite significant. I mean, this is a huge, over a decade long base that has formed in natural gas, and it has started to climb up out of that, which is interesting as well. And we are still seeing some sizable moves in natural gas depending on swings of the weather. We're now moving into home heating season, the peak demand time of the year for natural gas. So it's a contract that could remain active in the coming weeks and months. One more I wanted to highlight was copper. Copper is, with its wide variety of applications, is considered to be a barometer of sentiment, not only toward commodities, but also towards the world economy in general. And we can see copper just roared back to life through 2020 into the early part of this year. It's been going sideways, and now it's kind of bumping up against its highs. If we start seeing copper go $4.90, $5 a pound, that would be pretty significant breakout. Otherwise, we're, as I said, kind of bumping up against resistance here. We'll see how this goes. And of course, there's other ones as well. The price of lumber has been up and down like a rocket ship, and other ones as well. So at this point in time, I've completed my prepared remarks. I just want to know to send us your questions. If you have any questions, please send them to sales@siawm.com. We would be more than happy to address some of your more personal questions immediately, and also we address the most asked questions each month, of course, in the Market Insights section of our webinar. This is our fund codes and sales information as well. I'll just leave this up for a moment, and then I'll show our next slide, which is our compliance slide. But on the interim, I've completed my remarks. Jason, did you have anything you'd like to add here?
Yeah, thanks, Colin. Thanks very much. Appreciate the insight there. Some great questions we received from advisors over the past month. Please keep them coming in. We definitely want to address what's most top of mind for you and relevant in terms of your conversation with clients. With that will conclude the webinar today. Thanks again to everyone for joining us. And just a reminder, if you just take 1 minute and complete the survey at the end here, it would be greatly appreciated. And we'll be back in mid-December with our next Market Outlook webinar. Have a great week, everyone.